Welcome to Know More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Welcome back, everyone, to the CreditSights Know More, Risk Better podcast. My name is Logan Miller. I am the head of European strategy based in our London office. And today I'm pleased to be joined by my colleague, Anwita Basu, who is the head of country risk for Europe at BMI, our sister company within Fitch Solutions. So welcome to the podcast. Great to have you on. We've spent a lot of time together in the recent weeks. We did a trip to Italy to visit clients. We had a roundtable in Milan and a number of kind of meetings throughout Italy 2 weeks ago. I wish we had more answers as it relates to the geopolitical conflict in Iran. It seems like the market is still, and investors are still sort of struggling to figure out where this is shaping up to be. It feels like every day there's something, new to consider, and the market definitely feels pretty timid as it relates to where this is going to head. But, it's great to have you on. I think what I'd like to first sort of discuss is just, perhaps you can give us an overview of like how you were thinking about, Europe as a whole coming into this year and sort of maybe how that's sort of changed, over the last, 7 or 8 weeks.
Sure. Thanks so much for having me, Logan. It's an absolute pleasure to be talking to you today. We've had this conversation several times. Obviously, between January and now, so much of the agenda has shifted towards starting from the Greenland debacle from sort of planning for the future to crisis management, I think, in Europe's case. And let's not forget, this is the 5th crisis that we're entering into over the past 5 years. Mm-hmm. And there's been a lot of structural struggle in the region for various reasons. At the beginning of the year, we were hoping that this would be a year of recovery, especially on the back of expansionary fiscal policy in Germany, which is a new thing that we're seeing in Europe. And it would, in theory, be a huge stimulus for the rest of the region. Naturally, we come from a few years of technical recession in that German economy. So it was something that we were hoping would act as a massive stimulus. Mm-hmm. Another stimulus was going to emerge from sort of defense spending expansion, mm-hmm. of course, to a milder degree, because the European industrial complex isn't large enough to accommodate that potential demand that emerges from expanding defense spending. Mm-hmm. So spending would have gone towards importing technology from the US. Right. But of course, there were some concerns around fiscal slippage. I know this is something you want to discuss in more details.
Sure. Yeah, definitely. I would just say, I think it seems like, you mentioned there's been a number of crises in recent years. I guess for me, like the most surprising thing is just how resilient the economy has sort of been. And we've got, if you thought about, tariffs back in, this time last year coming on, and now you have, what's been very, choppy conditions for the energy market and rising oil and gas prices for Europe. I would probably think, we'd be in sort of crisis mode just economically, but, it feels like that's not been the case. Do you probably agree that the defense spending mechanism is probably a potential backstop for growth longer term? It seems like it's been a bit slower to sort of materialize in recent years, or over the last year, but perhaps that's something that, we're looking at as something, as a backstop more than the tailwind.
I'd say we took lessons from the pandemic when real sort of, to an extent, perhaps fiscal union became something of a reality, right? Because the European Union as a whole could issue debt, which was a big shift from what we saw during the debt crisis. And since then, we've had this sort of fiscal unionized funds under the RRF and the NGEU fund, and sort of looking towards consolidating some of the strategic goals at the union level and financing it via these new vehicles. Of course, at the end of the day, it does fall on the German kind of credit line. And you'd be able to speak towards the risk around that more. But that is a learning that I feel like the union has been taking forward, and it has helped it to mitigate some of these crises.
Yeah, no doubt. I think the other thing is, in our view, there's some pretty some pretty key differences between what we're seeing now as it relates to sort of the energy situation and perhaps the last time there was a major energy shock in Europe, which was 2022, obviously following the the start of the Russia Ukraine war. But yeah, I think right now it feels to us like we're sort of in wait and see mode. I think this situation could get worse on a dime. Conversely, I think it could end quickly, depending on the talks between the U.S. and Iran. We'll see. I guess just in terms of how we're thinking about the market, we think probably this means, interest rates remain higher for longer. If you remember 2 or 3 months ago, basically the market was pricing in central banks that were ECB that was likely to be on hold this year. We expected to see the BOE cutting rates this year, and that's definitely flipped significantly in the last 2 months. So in my view, it's probably more of this higher for longer rate environment. I don't think we've seen a material tightening up of credit conditions yet, to the point where, perhaps that means central banks, the worse the energy situation gets, the more central banks may have to respond to tighten up credit conditions, because we just haven't seen that sort of transition mechanism yet, in our view, at least in terms of public credit markets. I don't know if you think about that a little bit differently, or seeing something different.
And I think that is something, a conversation that came up during our visit last few weeks, is that we are, because of the already tight credit situation, we are in a very soft demand environment, right, across, particularly in DMs. And that's obviously linked down to the mortgage markets, remortgaging rates, and Britain, that's a big concern, because there's a fairly heavy load coming up for remortgaging at a much higher rate, and that's obviously curtailing spending. And we're already seeing, to an extent, that kind of feeding into the real estate sector in terms of house prices and so on. So that's definitely one area of asset erosion, if you want to call it, or impact on valuations at a household level, that we're quite worried about. But because we are coming into this in such a kind of fairly soft demand environment, also from the industrial side, because there was significant demand destruction, especially in Germany.
Definitely.
The transmission mechanism of this is blunted. And that's maybe explains why it's been slower than what we would have seen during Russia-Ukraine. Russia-Ukraine was also a geopolitically sort of actively managed energy crisis, in a sense that it didn't need to happen had Europe not cut back completely on pipeline gas from Russia. But of course, it was inevitable. And so there were policies and agreements in place in order to mitigate that, whereas this is more a crisis coming from external, from outside. It does mean that we're price takers, and we cannot actively manage it. Which is why I guess the transmission mechanism, at least that we are looking at for Europe, are kind of secondary risk transmission. Some of it is already seeping in, like jet fuels. And I'm quite concerned about the jet fuel shortage actually in Europe, because that does mean that our services sector through the summer months are going to be affected in a way that we're probably not absorbing in terms of risk as yet. And of course, the services sector has been the reason for any recovery that we've seen over the past few years from the pandemic years, right? So,
Yeah. I mean, I think the combination of rising prices and weak demand is sort of the definition of stagflation. And so it feels like we're sort of in this perpetual stagflation environment. But I also think the points you made about, consumer rates and the consumer side of the economy, it seems to be quite different than what we're seeing on, the corporate side of the economy, where, profits are still reasonably good. Balance sheets are in pretty good shape on the corporate side. Whereas, it does feel like, if we do really get in this higher sustained inflation environment, the consumer is going to feel, renewed pain, which, will ultimately feed back into probably weaker profit growth for corporates longer term. So it's interesting kind of vicious cycle that we could be entering, but I don't think we're quite there yet, pounding the table on, calling for, a major slowdown just yet. But yeah, I guess I'd be curious from your perspective, like, how does this sort of shift the strategic priorities of Europe? Or, how are you thinking about sort of the competitive landscape? You mentioned a little bit this being something that's exogenous and sort of out of Europe's control, but obviously has impact. How are you thinking about it?
that's a very good question. That is something that because we've been facing all these crises for the past 4 years, every year the strategic priorities keeps shifting, right? Like 4 years ago, we were talking about green transition being the next big thing. And now it's sort of, uh, a part of the narrative somehow, but it's not front and center as it was a kind of a big priority of the European Commission elections just kind of 4 years ago. And again, the start of the year, the focus certainly was on Readiness 2030, which is the defense package, which I would imagine still remains a big part of the priority, but then that does shift the energy transition goals further down the line. And this particular crisis is a really interesting one, right? There is a geopolitical crisis. There's a transatlantic geopolitical crisis, which necessarily requires Europe to be strategically, and by that I mean from a security standpoint, more independent. You already have Russia as a threat, which continues to remain a threat and is leveraging its position by cutting off Germany's access to Kazakh oil, or creating sort of invasive practices in the political landscape and all of that. So it definitely remains a threat, and therefore needs to be a strategic priority for Europe. And at the same time, you're sort of faced with this perpetual energy crisis because, as we pointed out, that Europe being a price taker across the board necessarily needs to think about alternative energy as a key priority. So I do think that, and the more you follow European Union policy, there's this constant dichotomy. Some regions have decided to focus on one thing. Like, for instance, the Iberian Peninsula has categorically focused on energy transition and actually is doing quite well out of this crisis.
Yeah.
They are relatively protected by then gas price movement. And that's actually at least fiscal positive, because they were traditionally bigger kind of spenders and have higher debt, and there was a concern around debt sustainability there. But then you have other regions like, say, Italy or Greece, which remains very leveraged on gas flows and haven't quite benefited from energy transition. So to answer your question in a long about way, they all need to be strategic priorities and all feed into the ultimate question, which is competitiveness, that has been massively lost since the European energy crisis, because we were already compromised from a competitive perspective, because unit labor costs and unit marginal costs in this region were high to begin with. But since the crisis, since the Russia-Ukraine war, it's gone up by almost 25% compared to all its major competitors, US. And against this backdrop, prices in China have gone down. Their unit marginal costs have gone down. So the competitive landscape looks really, really difficult for Europe. And the only way out is to kind of look inwards rather than hope that exports and the external sector is going to be a source of growth.
Yeah. No, I think, one thing someone I used to work for used to say was that hope is not a strategy. And definitely I think, the more you can just kind of actually make decisive, moves is more important than just kind of hoping that things will be resolved. So I guess, that takes me to like, where do we go from here? Like, how are you thinking about, especially kind of in the near term, are you looking for, I mean, does BMI think, we're entering, this kind of prolonged period of muted growth, or is there a risk of recession? Like, how are you kind of thinking about balance of risks for Europe?
So, we're not quite there yet when it comes to stagflation, because the inflation outlook is still fairly anchored, I think, at least in DM Europe. But of course, it is gradually, where we're seeing, particularly, I think, when we speak to clients on the ground, seem quite concerned about how long that's going to last for. We're working off various scenarios, obviously, because it's quite a unique position we find ourselves in Europe after a long time, that this is a crisis we can't control. Whereas, like I said, with Russia, Ukraine, it was policy driven. So, there were mitigating factors that could kind of ease that blow depending on where in Europe you find yourself. Right. But right now we're price takers. So it does mean that the narrative is driven by the Middle East crisis and how long Hormuz is going to face the disruption. So we're working on various scenarios. At the moment, we expect there to be some sort of a resolution. I think that that's something that you're also working with as a scenario. And if there is a resolution by the end of May, it does mean that this shock, the price shock and the supply chain shock, is short-lived and definitely much smaller as impact as the Russia-Ukraine situation was.
Definitely, yeah.
Which does mean that we return to some form of a recovery path, because, as to my earlier point, Germany remains expansionary still. We are going to see increased investment in domestic industrial capacity. There is still a focus on energy transition, which does create a different type of demand, but it is demand positive to an extent. And of course, we have we haven't even touched upon these ideas around efficiency gains from AI deployment or
we can do a whole other podcast.
Yeah. I mean, that's yeah. So there are positives kind of there was a positive momentum coming into this year. And as you said, we were fairly resilient through the tariff strains, mainly because a lot of the exports that was going into for European exports going into Europe, into the US, were not replaceable, right? Particularly pharmaceutical components and so on. So it's not all doom and gloom, but certainly the risks of entering into prolonged stagflation is now much higher, as long as we have these various supply chain shocks. And to be honest, I don't see a very good way out of it, really. And it would probably worsen if Europe gets actively involved in this war, which, I mean, I think we're all hoping they don't.
I think everyone's hoping for a resolution.
Definitely. Yes. Yeah.
We'll just have to see how that shakes out. I do think we were talking about earlier, just the market feels like a bit disconnected and a bit, confused around what the ultimate impact is. And we mentioned equities in Europe are hovering kind of near the highs. We've had a bit of a pullback and we're sort of recovering from that in March. But, the rate side of this story feels like this is going to have lasting longer term kind of consequences. And I don't know. So we've seen obviously rates moving higher. And if you look at some of the countries that you mentioned that are a bit more sort of susceptible to higher energy costs, Italy is a good example. They obviously import, a large amount of sort of the LNG from the Middle East. And we're seeing, rates basically at, new cycle highs for some of these, sovereign countries. But at the same time, if you were expecting recession, you would think that, okay, well, the risk-free rate, which is the German Bund curve, would be actually declining in this sort of environment, but it's not. It's actually moving higher as well. So I think, the rates market feels like it's a bit more on edge than the equity market. Well, I guess we'll have to see which one gets it right. I don't know. I think we'll start. We could be in a scenario where we start talking once again about, okay, what is the implications of rates remaining higher for long? No one's really talking about that right now as a big risk. Feels like to me. Obviously that would probably impact, corporates or impact consumer. The entire sort of economy revolves around, debt effectively. So yeah, we'll have to see, how that kind of shakes out. I guess I'm curious, are there any other things that you're looking at, not excluding sort of the Iran situation? What else is BMI sort of really interested in? And I guess, are there anything that clients have been sort of asking more about that are non-Iran specific?
Yeah, I mean, I think clients are sort of in the same position, particularly in Europe, that they kind of want to, this is a situation they can't control, and they want to kind of set it aside and talk. But then it always boils down to, well, what's the view on rates, and what's the view on the euro, and what's the growth outlook, and what are the main drivers? And it's just very difficult to ignore the kind of external issues, especially given how much it has become a sort of volatile. We've always operated in a space where the external side hasn't been as volatile, that, the topic of transmission changes from day to day. So first it was trade, then it's energy, then it's security, then it's something completely, then it's potential, US invasion of Greenland. Like, the transmission keeps changing. So I think from a client perspective, that's been a concern. But what clients have been, at least from our side, been very focused on is trying to capture the impact of geopolitical volatility on the macro environment. So be it any type of event, what does that mean from a day-to-day kind of policy decision making, and then obviously the macro environment, because again it's become the key driving force, and that's obviously something that has been playing to our strengths to that effect. I think in Europe specifically, obviously you pointed out the competitiveness issue. There is concern around, how do we actually address this?
Yeah.
Are we, putting ourselves into the same position as we did earlier, that instead of relying on Russia for resources, we're not over relying on the US, and could that be a source of future strain? Some positive kind of momentum around foreign trade agreements and diversification. So we saw the Mercosur come into play earlier this year. We saw an FTA with India. So there's been some kind of positive diversification, which is something clients have been catching onto and hoping, again, even though hope is not a strategy, but have been kind of looking into plays there. Another concern is the change in US strategy on Russia, because that has meant that there has been a lot more focus on European defense and security and its ability to offset that threat. So that's definitely something that we've been working on or focusing on a lot more. So it's been a mix. There is events in Europe specifically which have driven the conversation, like obviously the Hungarian elections is a big one. But I think it's been difficult for clients to even kind of trying to look past this situation, because it's always comes back to the fact, well, are we here again with Europe? Do we have yet another strategic problem to concern ourselves with? So it's been interesting. I do think that there's been a lot of really good work being done, or good thinking being done around energy transition, even though there's been sort of a pushback against the ETS system of the carbon trading mechanisms, because I do think that is an area that is quietly coming back into focus, and there has been appreciation that this is something we need to reprioritize.
Right. I mean, it makes sense, right? Because I mean, if I think these sort of conflicts and these sort of shocks, perhaps are a reason for a refocus.
Exactly. Yeah.
Lessening your dependence on sort of foreign sources of energy. So I think that'll be interesting to shake out. I guess I have one more question. Are you at all sort of thinking about the impacts of the U.S. economy right now, or all in terms of Europe? I mean, I feel like we've been a bit cautious on our from a strategy side on the U.S. Are you thinking about that as being a weak point, or not? Is that too so early for that?
The U.S. is a very interesting situation, because obviously there was a break in the contract with the tariffs. So fundamentally, we expected weaker growth from the weaker demand from the US, because most European exports now face above average tariffs, right? Probably not as bad as many other regions, but it's still much more expensive. But high frequency data, I mean, of course, you'd be more familiar with this than I. High frequency data from the US has been fairly bullish, but of course it's been specifically around investment in AI and technology and by efficiency gains that fundamentally means it's demand negative, because efficiency gains do mean there's going to be some job market effects of that, which we haven't seen yet, but we will eventually. That's a really good question, because the US weakness is completely mirrored in our fairly cautious view on Germany, and then that obviously has a domino effect on the rest of the European region. So yes, we remain worried about that. It's just difficult to pinpoint contagion from the US at this stage, because is it geopolitics, or is it, I don't know, private credit, or is it bubble bursting, or is it something completely different, because it's just been so volatile in so many different ways. But at the same time, as you rightly point out, there's been a lot of momentum in capital investment, particularly in technology, and the equity market has reflected that. So it's been difficult to say this is going to be the exact transmission from the US. What we have done is followed our rates call, sort of follows more or less the Fed call, except in Britain, where, for obvious reasons, as we are expecting BOE to be more hawkish than most of the other central banks. But we took out sort of an extra rate cut in the view. So now expect only one potential rate cut in the US. And that then does mean that it justifies ECB not changing its rate or staying on hold. Because as you said earlier, ECB is always behind the curve anyway. So it's likely going to be that, because it's so consensus driven. But I do feel like sooner or later there's gonna be break in this consensus in Europe, because we've seen sort of some countries being extra cautious and extra concerned about all these contagion risks, and some sort of taking a bit more blasé attitude towards it, and that to me is a bit concerned.
It does feel like on a country specific level in Europe, everyone is handling things a little bit differently.
Yes,
which is a little bit of a concern, because you kind of you kind of need a cohesive cohesive strategy to deal with these situations, when you might have still some divergence in sort of opinions among European leaders. I mean, the EU is a whole different story. But yeah, it'll be really interesting to see how this shakes out. But this has been a really interesting conversation. I mean, there's a lot going on right now. There's certainly it feels like things are kind of boiling up beneath the surface. We'll just have to see how things kind of play out. But otherwise, I appreciate you coming on today. And definitely, if anyone listening has any questions for Anwita or myself, please feel free to reach out. But we look forward to seeing you all next time. Thanks a lot.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.